For decades, silver has been treated as the quiet cousin of gold. Less glamorous, more industrial, easy to ignore. But when silver approaches levels like $79, it stops being just another commodity and starts behaving like a signal. Here's the mystery. Silver doesn't spike like this during calm, confident periods. It moves when something underneath the system is breaking or about to be tested. And historically, when silver sends a loud signal, the stress doesn't stay in the metals market. It spreads. So the real question isn't why silver is rising. The real question is what silver is warning us about next, and why tech stocks and governments may be directly in the crosshairs. Silver occupies a unique place in the global system. It is both a monetary metal and a critical industrial input. It sits at the intersection of finance, technology, and government policy. Historically, silver has surged during moments of monetary distrust, currency debasement, debt expansion, and loss of confidence in fiscal discipline. At the same time, modern economies increasingly rely on silver for solar panels, semiconductors, electric vehicles, and advanced electronics. This dual role creates tension. When financial fear rises and industrial demand accelerates, silver doesn't move gradually. It reprices, and that repricing often precedes broader systemic stress. The origins of today's silver warning signal trace back more than a decade. After the global financial crisis, governments chose debt expansion over structural reform. Interest rates were suppressed, money supply expanded. Asset prices inflated, especially in technology stocks. At first, this worked. Growth returned, markets surged. But the cause and effect chain didn't disappear, it was delayed. Cheap money increased leverage. Leverage increased fragility. Fragility made systems sensitive to shocks. Silver, during this period, stayed relatively subdued. Confidence in financial assets remained high. But the foundations were quietly weakening. As inflation returned and supply chains fractured, silver demand began to rise from two directions at once. On one side, investors started questioning fiat stability. On the other, governments pushed aggressive green energy and digital transformation policies, both heavily dependent on silver. This is where the cause and effect accelerates. Rising industrial demand tightens supply. Monetary uncertainty increases investment demand. Tight supply meets rising demand and price pressure builds. Silver's rise isn't speculative hype alone. It reflects structural strain between physical reality and financial promises. Price levels matter psychologically, but they matter even more structurally. At elevated levels, like $79, silver begins to expose uncomfortable truths. Industrial users face higher costs. Governments face supply vulnerabilities. Financial markets face a contradiction. The very technologies propping up growth depend on a metal signaling monetary stress. This is the breaking point. If silver remains elevated, it pressures tech margins. Solar, EVs, data centers, and chip manufacturers all feel the squeeze. Meanwhile, governments pushing green transitions face rising costs and resource constraints. What began as a metals story becomes a systems test. Historically, when silver breaks out strongly, the fallout appears elsewhere. Equities tied to growth narratives become vulnerable. High-valuation tech stocks priced on cheap capital and optimistic assumptions face scrutiny. Governments running persistent deficits face rising skepticism as real assets outperform paper promises. The effect is subtle at first. Volatility rises. Correlations break. Confidence erodes. Silver doesn't cause these problems. It reveals them. Governments respond predictably. More stimulus. Strategic stockpiles. Regulatory adjustments. Central banks attempt reassurance. But these fixes often worsen the signal. More liquidity supports asset prices temporarily, but reinforces inflation expectations. Resource intervention exposes supply fragility. Political promises clash with physical limits. Silver has a history of ignoring narratives. It responds to constraints. When policymakers attempt to suppress symptoms instead of addressing root causes, debt, productivity stagnation, and over-financialization, the warning signal grows louder. Look back at previous silver surges. They often coincided with stress in equity markets, currency systems, or government credibility. Not immediately, but eventually. Today's parallels are striking: record debt levels, fragile tech valuations, aggressive industrial policy, and rising geopolitical risk. Silver at $79 is not an isolated event. It fits a repeating pattern where real assets challenge financial abstraction. The data doesn't predict collapse, but it does suggest a test. So what does silver at $79 really mean? First takeaway. Silver rises when confidence in financial systems weakens and physical demand tightens simultaneously. Second takeaway. Elevated silver prices pressure tech sectors and expose the cost of policy-driven growth narratives. Third takeaway. Governments cannot easily manage signals rooted in physical scarcity and monetary credibility. The warning is simple but uncomfortable. When silver speaks loudly, ignoring it rarely ends well. And the open-ended question remains, will this signal fade as another false alarm, or is it the early tremor before a broader market test? If you value deep, cause and effect analysis beyond headlines, support the channel by liking the video, subscribing for future breakdowns, and sharing your perspective in the comments. Because understanding warning signals matters most before they become obvious.